It is inflation day. We are just 5 minutes away from the latest consumer price index numbers coming out. I am Simone Del Rosario. I'm the business correspondent over at Straight Arrow News. And every time one of these very important economic releases come out, we come live to you on YouTube to share it in real time with a very informed guest. So today I want to bring in our guest for today's inflation report, the Fed Guy, Joseph Wang. You got to follow his coverage over at fedguy.com. He is on top of all things central bank, and we're talking jobs, we talk inflation, and of course, the Fed decision. Joe, thank you so much for joining me this morning.
Hey, Simone, great to see you. Pleasure to be here.
Yeah, we've done this before when, the Fed has come out with rate cut decisions. And of course, now we're talking on inflation day. And this is really the last puzzle piece that the Fed is going to get before they make their decision next week, which, everybody believes at this point that a rate cut is almost certain. I'm going to guess you're in the 25 basis point rate cut camp. Is that right?
You're exactly right. So let's level set a little bit. Usually the Fed does 25 basis points per hike or cut. But right now, though, there's a lot of speculation in the markets that the Fed may actually do a supersized cut of 50 basis points. The market is pricing in maybe a 30% chance of this. Now, the market is thinking this because the market is sniffing out some economic weakness. They're noticing that the unemployment rate has gone up. It seems like there's a lot of indicators that the Fed might be over tightening. And so, in order to get ahead of this, the Fed might want to do a supersized cut. Now, I'm not in that camp because so far, what I hear from Fed speakers is that it's more likely that the economy is normalizing. Now, for example, looking at the jobs created each month, we were used to creating 200,000 jobs a month for months on end. But now we're creating about, say, 100,000, 140,000 jobs a month. That's kind of normalizing to the pace before pandemic. And so if we're just normalizing, and I think Fed speakers are thinking about it this way, they're probably just going to do a normal cut. Now, another piece of that puzzle, not just the economy, but inflation is also important, but a little bit less so today. Now, everyone has been focusing on CPI data for the past 2 years because that's been the Fed's main focus, inflation. Now that inflation is coming a bit more very close to the Fed's target, I think the market is focusing a little less on that. But today's CPI print would really help the Fed to decide whether or not to do a 25 or 50 basis point cut, depending on how extreme the prints are. Now, if we get this huge, huge upside surprise in CPI, which I don't think anyone is expecting, then we're definitely going to get just 25 basis point. Now, on the other hand, if we get a really surprise to the downside, CPI prints really cold, then we could easily go for 50 basis points. But I think right now the expectation is that CPI basically is comparable to last month. So I don't think the market is very anticipating big changes at the moment.
So let's talk about those expectations for today. Right now, what analysts are pricing in is that the core CPI numbers, those are the things that exclude the more volatile food and energy. They're going to stay exactly what they were last month, which is 3.2% on an annual basis. However, when you do the all items, when you throw everything back in there because they expect gas prices to be quite a bit cooler, they're thinking that CPI as a headline number is going to go down to 2.6%. We were at 2.9% last month. So that is significant. And in fact, last month's 2.9% was the first time we were below a 3% inflation rate since early 2021. So quite a significant step down on that headline number. Um, what do you think about the difference between core and headline before we get the actual data for this month? It seems like core is just saying so much stickier. Should the Fed look more to what people are actually paying?
Yeah, so I'll make two observations on that. First, for the Fed, so if you are an economist, you actually tend to pay more attention to core than headline. Now,
Mhm.
the difference between the two, as you note, is that the headline contains things like food prices and energy prices, which, while very important to the consumer, are very volatile. So you could have some event in the Middle East and suddenly get high headline inflation because of oil prices, and that could go away. And so economists tend to think the core readings now excluding food and energy to be more predictive of the actual underlying inflation trend. So they're going to focus on core. Now, core, as you suggest, has been year over year around 3% for some time. It's actually quite surprising that it looks like CPI is just kind of stuck around 3%. There is some news that on a month over month basis. It's improving, but year over year, not so much for the past year, actually. Now, another observation, and this is very important when it comes to the Fed, is that the Fed actually doesn't look at CPI. They have another
Right.
measure of consumer price inflation. It's called PCE. The two are very similar, but not the same. What CPI will do, though, it will help us understand what PCE will be. Now, PCE has been printing slightly below 3% for the past few months on a year over year basis. And so that's why the Fed feels that inflation is more under control. They're looking at something that is similar, but not the same as CPI.
And CPI comes out a little bit earlier than PCE. So, of course, we can look at, and I'm sure you're looking at your screen right now. Just
Yeah.
refreshed the Bureau of Labor Statistics report. And so we have the new numbers for August. I'm going to read out, they really came in kind of as we expected. That monthly increase went 0.2%, which was as expected. That headline number of inflation is 2.5%. Now, we said that expectations were averaging out around 2.6% for this month. I did see some economists thinking it was going to be 2.5% annual rise in all of the consumer prices. So you put in all the baskets of everything that Americans are paying for today, and it is 2.5% more expensive than it was last year. The Fed's target inflation rate is 2%. If I scroll down and take a look at core, came in just as expected, 3.2%. However, that monthly jump of 0.3% is slightly hotter than what was expected. As you're quickly digesting these numbers, Joe, what are you seeing?
So I agree with you. What really jumps out is that higher than expected month over month core CPI at zero point 0.3 rather than zero point 0.2. Everything else was spot on as the market expected. Now that month over month number though is troubling because that suggests that, maybe inflation, month over month obviously is just what happened this month compared to last month. And so it's more real time. It's closer to what's happening right now. And that suggests that, inflation is not steadily coming down as we really want. And the market's reaction to this is interest rates higher, and you see that immediately. And I think that completely seals a 25 basis point cut rather than a 50 basis point cut at the next Fed meeting, because inflation is not going down as fast as the market expects. Now, this is really just a small miscalculation, zero point 0.3 rather than zero point 0.2. But at these margins, I think it's enough to make 25 basis point the very overwhelming likely outcome of the next Fed meeting.
Yeah, I would agree with that. It's very slight, but we're looking at a Fed that has been so data dependent. They are going to be looking at that monthly increase on the core level. And the biggest driver of that is going to be shelter. Shelter surprised to the upside last month. It was hotter than expected. And now it's even hotter than it was last month. So, shelter, what it costs to put a roof over your head, went up 0.5% the month of August and is, pacing a 5.2% rise from a year ago. These are high numbers, and it's weighted so heavily in this index. I know that shelter is a lagging indicator. It takes a while for what people are actually paying on the streets to catch up to what we're seeing on our screens. But what's your take on this? It doesn't seem to be a lot of budging when it comes to this area.
Yeah, you're exactly right. So over the past year, past 2 years actually, all the experts have been telling us that shelter is a lagging indicator. It's going to come down. It's going to come down. It's just not happening. I think it's helpful to understand why they think it will come down. So the way that normal people usually when you sign a lease, it's 12 months, right? And so when you sign
Mhm.
a lease, let's say the rent goes up, you don't actually renegotiate your lease until 12 months later. And so if the rent goes up, it doesn't really show up until 12 months later. And so what people have been looking at is that the newest leases just signed are not having a lot of increases. And they're saying that these new leases eventually are going to get averaged in. And so the average shelter inflation is going to increase at a lowering rate. Now, I think these people have been consistently wrong because they're missing one of the biggest economic developments that have happened in this country the past couple of years. That is a tremendous increase in migration. So we actually see this happen in Canada and in Australia as well. It's a very basic supply and demand. When you have more people in the country, they need to live somewhere, right? And it
Hmm.
takes time to build a house. It takes a lot of permits and things like that. So at Canada, looking at Canada, for example, they increased their population by about 3% in 1 year. The same thing in Australia. And what happened when you have millions of people entering the country? Well, there's the amount of housing doesn't really change that much in 1 year. And so their rents went up like a rocket ship. The exact same thing
Yeah.
happened in Australia. A lot of people come in, they got to live somewhere. And so rents go up like a rocket ship. Now, in the US, it's a little bit different because we're a bigger country. We have migration, not as much as the other countries, but also migrants are going to different segments of the country. Now, looking at New York City, for example, the vacancy rates are actually the lowest they've ever been because a lot of migrants are going there. And as we all know, it's hard to build housing in these big cities. And so I think one of the reasons why rent has not come down as expected is because our population is growing significantly. And I think that's probably going to keep upward pressure on rents for the foreseeable future, largely depending upon what happens in the November election.
And the things that you're describing are not things that the Fed is going to be able to control with its monetary policy, right?
No, no, no. So a lot of this is partially having a little bit to do with monetary policy in the sense that when you have lower interest rates, it's easier for builders to finance projects, to build more housing. But that's only
Mm.
one part of the picture. When you build a house, you got to have permits, you got to have all sorts of regulatory stuff. That takes a lot of time, and it's largely up to the local government. So, the Fed is part of the picture, but I don't really think it's the biggest part.
And when I, look a little bit more into what the Bureau of Labor Statistics is saying about these numbers, shelter for this round is accounting for 70% of the total 12-month increase in that core CPI number of 3.2%. So when I talk about it being very heavily weighted in this index, this is what I'm talking about. Without the shelter component coming into focus and really, getting less and subduing a bit, we're not going to see that core get closer to the Fed's 2% target. That's what I'm taking away from this.
Yeah, I think we might be in a new higher inflation regime. So we have to be careful. The future does not always look like the past. Over the past 20 years, we've had a world where inflation was pretty stable around 2%, but it wasn't always like that. Now, before the quote unquote great moderation period, we were in the 70s and 80s, 1970s and 80s, where inflation was volatile and sometimes very high. I think we're heading into an era where inflation is probably going to be more volatile and higher than it was in the past. That's certainly what the CPI is telling me. Now, looking on a year over year basis, we've been above 3% for some time. And honestly, it looks kind of stuck there. Now, we could have
Mhm.
recessions that temporarily bring that down. But I think the next time we have a recession, maybe we just have tremendous more stimmy checks and so forth, and that makes it surge again. So I think the future is going to be a world where inflation is going to be higher and more volatile, and um, that's something that we're have to going to get used to.
Fed Chair Jerome Powell gets asked this a lot. He loves to slap this down, which is, is the 2% target rate out of the way? Should we be looking at a 3% target rate? The economy has been doing very well, comparatively to longer periods of time. I know that we are seeing some softening in the labor market, but for so long, the economy seemed to really be pumping along. And to your point, we've been really stuck right around this 3% level for some time. So that brings up the question, is the 2% target outdated at this point? Should we be looking at a 3% target? I know that Jay Powell hates this. He's like, no, we are a 2% target regime. But what are you hearing? Are you hearing anything different? Are they sticking to those guns? Or because we continue to see inflation at this level, to your point, you don't want to trigger a recession just to get it down to 2%.
Yeah. So we have to realize that the 2% inflation target, it's nothing magical. It's nothing set in stone. It's a decision made by people. Now, in the Fed's case, it was decided in 2012 to have an inflation target of 2%. Doesn't have to be that way. We could easily change it. Now, I think it's helpful to understand why we might want to change the target. So, traditionally speaking, economists think there's a trade off between inflation and unemployment. So, they would think that if we have 3% inflation, in order to get 3% inflation down to 2%, we have to have a bit of a recession. We have to have unemployment rate go up a little bit. So ultimately, whether or not we decide to have a higher inflation target is a political decision as to whether or not the government can tolerate a temporary recession. When inflation was around 4% and it looked like it wouldn't come down, there were actually many people, influential people, writing columns in big newspapers saying that, hey, why don't we just change the inflation target so that it's, 3% or maybe a little bit more instead of 2%? They were saying this because they did not want the political costs of having temporarily higher unemployment, of creating a recession. So whether or not we change the inflation target is ultimately going to depend upon the political appetite for economic weakness. Now, honestly, at 3% inflation, I think that's close enough to two that people will just kind of shrug and say, yeah, it'll eventually get there, and they won't have to change the target. But the next economic cycle, when we have an upswing, maybe inflation goes back to 4%, maybe a little bit more. Depending on who's in power, maybe they don't want to take that risk of having a recession to get inflation down. And maybe at that time, we'll have some serious conversations within the government whether or not they could change the inflation target. Now, to your point about what the Fed people have been talking about now, definitely they would never say that they're going to raise the inflation target. But at the moment now, they are having a discussion about their framework, and that's due to be released
Mm,
in a couple years. Now, there are former Fed speakers who are whispering that, instead of having a 2% inflation target, what if we have something called an inflation band? So, what that means is that, my target is not 2% point, but maybe it's 2% plus or minus 1%. So, that means that inflation is 1.5%. Yeah, it's within the band. It's okay. If it's 2.5% or even 3%, that's okay as well. So, that could be a way to kind of by by sleight of hand increasing the inflation target simply by tolerating inflation higher than 2% because it's still within the band. Now, that is something that people discussed before in the Fed, and now they're discussing again. And I don't know what they will ultimately decide. I think it might depend upon, just how easy they think it is to maintain 2% in the coming years.
That makes a lot of sense to me because it's hard to nail down a perfect 2% core PCE for a very long time, month over month, with not giving yourself that level of wiggle room. It would be interesting to see how those conversations go. As you said, they're going to be starting that process this year to be looking at their framework. You mentioned unemployment and how this is weighing into it, and we know that since we've seen more significant softening in the labor market, especially in the July report, we saw the Fed really shift its focus from we've got to bring inflation down to 2% to oh, hey, there's stuff happening over in the labor market that we need to be more concerned about. I'll remind our viewers that the Fed operates on a dual mandate. One is price stability, that's the inflation, but the other is maximum employment. And for so long through this inflation cycle, we've had an incredibly tight labor market and historically low unemployment rates for the modern era. Right now, we're sitting at a 4.2% unemployment rate. And in August, 142,000 jobs were added. That said, we have had repeated downward revisions to the amount of jobs added in the economy to the detriment of what we saw down in July when we had a horrible jobs report and the unemployment rate went up to 4.3% for a minute. But the amount of jobs added even got downgraded below 100,000. So we are looking at a lot of movement over in the labor market. What's your read on those shifts that I was talking about with the Fed and, thinking that this 3% inflation isn't such a bad thing after all, because we've got, a flashing light over here, which is the labor market.
So the labor market has been really hard to read over the past year. Now, it's been hard for a couple reasons. One is that during the pandemic, all sorts of crazy things were happening. One of the things was the rise of the gig economy, where suddenly, instead of working for a company, a lot of Americans wanted to start their own business. Now, that created a tremendous amounts of small businesses, and the way that the The BLS accounts for that is something called the birth death model, where when you have a new business, it takes some time for employees to be counted from that new business into the data. And so they do a statistical adjustment. Now, right now, over the past few years, over the past couple of years, Americans are creating fewer new startups, fewer new jobs. And so when they're using that same statistical adjustment they used during the pandemic era, it's over creating jobs, right? So that
Mm,
revision has taken away a lot of jobs as they realize that, the startup culture that we saw during the pandemic isn't as strong as it was. Now, that's one thing. Now, the other thing that's making it very difficult to get good labor data is because we have tremendous amounts of migration, much of it illegal. Now, the CBO, the Congressional Budget Office, is thinking that maybe we had 3 million illegal migrants last year, maybe more. It's really hard to say. But when you have all these people entering the workforce and much of them working off the books, it's harder to get a sense of just how many people are in the country and how many people are working. So the labor data has been very unreliable lately. But unequivocally, though, it's just trending in a weaker and weaker direction, as you noted. Now, the question is, does this mean that we're falling into a recession, or is it just normalization? After
mm,
all, pre-pandemic, the economy was creating, yeah, let's say 150,000 jobs a month. So 140,000 is comparable to that. So maybe we're just normalizing. After all, look at everything else. We saw tremendous upward surges in pricing during the pandemic, but now, price increases are about the same rate that it was pre-pandemic. Is this another normalization, or is it that we are really just decelerating towards recession? Now, that's the problem that the Fed is struggling with. And so far, Fed officials are coming down on the side of normalization. And so I don't think they're super worried about the labor market just yet. Now, Chair Powell has been very clear. He doesn't want to see any more rises in the unemployment rate. But the unemployment rate is still historically not super high and not super concerning. It's just that we don't want to see any more deterioration.
And the Fed has a long runway if there were to be further cracks in the economy, and that is that our interest rates are very high, comparatively speaking, higher than they've been in the last 2 decades. So let me ask you about what we're looking at moving forward when it comes to Fed rate cuts and Fed decisions. You've already said that you believe that September's meeting next week will be a 25 basis point cut. What is the next year and a half look like if they can keep the economy kind of running the way that it is? We have, after the September meeting, the next meeting doesn't come until the 2 days after the election. So there's a little bit of time there. But then what are we seeing into 2025 and beyond?
So the market is pricing in a very, very aggressive Fed cut cycle, so aggressive that the market is pricing by the end of next year, the overnight rate will be below 3%. So that's from 5.5% today to below 3% next year. Now, that's a very aggressive rate path policy, expected policy pricing by the market. And that seems to assume a significant deterioration in the economy. Now, let's look at the big picture, though. Now, the most recent GDP statistics in the US were revised upwards from 2.8% annual growth rate to 3%. So the economy is actually growing fine. There's really no indication that we would just suddenly go from 3% to a recession where we grow. When we don't grow, we shrink. Jobs reports, again, slowing, but we're still creating over 100,000 jobs a month. When we're in a recession, we don't create 100,000 jobs a month, we lose 100,000 jobs a month. And so the pricing in the market seems to be pretty aggressive from my perspective. I think there's too much doom and gloom being priced in. My base case expectation is that rather than having a series of huge cuts that the market is assuming, that we have some steady 25 basis point cuts, and maybe the cut cycle ends, let's say, around 3.5% rather than below 3%. I say
Mhm.
this because, by all indications, the economy continues to have momentum, and there's a good case to be made that rather than falling into recession, we really are just normalizing. Now, one other thing that I would mention is that something that's happening today that hasn't happened before is that we have tremendous amounts of fiscal spending. The government is expected to have a fiscal deficit of about a couple $1 trillion, basically forever. And when you have the government spending so much each year. That's very supportive of demand. It's upward pressure on inflation. It's not a very good management of uh, the currency, but it is supportive of demand. And so when you have that kind of, I guess, fiscal spending, I think that's a good tailwind. Now, one other thing to keep in mind is that what happens in November could have very big implications for macro policy. We have two candidates with very, very different visions of the world. Again, we also have to look at Congress to see whether or not they are able to carry out their different visions of the world. So there's a lot of
Hmm.
uncertainty there. But based on what I see right now, the economy is still okay, and the rate cuts in the markets are too aggressive. We'll have some, but it doesn't seem like we would have so many because it doesn't seem like at the moment that we are tumbling into recession.
Can we talk about what the base rate is and should be moving forward? We had such low interest rates for so long, and I think there's a good argument to be made that after the Great Recession and the many years that followed, we didn't move quickly enough to start to normalize that situation. So, for a lot of people, they've felt a very low interest rate environment for a very long time. You're saying you see a rate cut campaign that ends around 3.5% compared to a more aggressive market prediction of 3%. Is there a good argument to be made for the Fed's rate to be higher than what would be considered normal before in a healthy economy?
Yeah. So what you're talking about, what you're referring to is what economists refer to as the quote unquote neutral rate. Now, that's the rate where the Fed thinks that the interest rates are neither stimulating the economy or slowing it. Now, during the pandemic, or before the pandemic, between the great financial crisis and the pandemic era, we had very low interest rates. I think it's important to look at that era in the context of history. Now, having 0% interest rates is a historical anomaly. Now, before the great, let's say, before the financial crisis, interest rates were around 4 and 5%, and everything functioned fine. So I take the view that that post financial crisis era of 0% interest rates was very much an anomaly. And going forward, we're going to have a world where interest rates don't go back down to zero, maybe stay around 3.5%, as I noted before.
Mhm.
And there's a couple reasons for that. One is that we have some inflationary pressures that are happening through demographics. Now, as we all know, the U.S. population is aging. Now, I think aging population is something that is inflationary. The way that I think about it is imagine right now if half the country immediately retired tomorrow and then went on carnival cruises and played bingo the whole day and lived off Social Security. Well, if you have half the people just stop working and just continue to consume, continue to go to restaurants, who's going to do all the work, right? So that is going to put demand for labor, demand for all sorts of goods and services. But because they're not working, that's going to reduce the supply. Now, as we move into an aging society, there's going to be fewer people working, but those people who retired continue to consume. And so that's going to shift the supply and demand dynamics to be more inflationary, especially when it comes to wages. If you have a more inflationary world, you're going to need to have higher interest rates to entice people to not to consume immediately so as to leave those
Mm.
goods and services to someone else. The second thing I think that is happening today is that, as I discussed before, there's tremendous amounts of deficit spending that is inflationary, all things equal. So we're going to need to have higher interest rates to kind of tamp that down.
I never know where this conversation is going to go with you. And I love the nuggets that we get to uncover along the way. You are you have so much information about the economy in so many different ways and how it moves and how it works. And you're tapped into the people that are making the decisions. So I really appreciate you coming on this morning as we got the latest inflation numbers coming out as expected. A little bit of relief for people on obviously the energy index. That whole index down 4% from last year. So people getting a lot of relief there. So I wanted to end on some good notes there when it comes to what we're seeing in those inflation numbers because they are significantly down from what they used to be. But Joseph Wang, the Fed guy, fedguy.com, go check out his stuff. Thank you so much for your time this morning. I appreciate it.
Thanks for having me.